Okay. All right, then, even under 80. Wow, that's a bold call there. All right, Rick, take us through what the technicals look like for NVIDIA.
So on this chart here, if we were to take it back a little bit further than 1 year, we would see that right about where we are now is the old highs from 2024, around 90, like around that general level here. It's just kind of just out of the view of this particular chart here, but you can see that there's heavy volume at this low area near 88, 90, around that point. You can also see our light green line matching up with that low from August 5th, a significant low point for so many stocks here. Recent price action forming a falling wedge type of shape here. We've fallen below all our moving averages. They're all trending downward. We've given up the volume profile point of control. RSI trending lower. Out of the oversold area, but still not anywhere near that 50 midline that would suggest a shift to bullish momentum once again here. So I kind of see Doug's point here. If we start to break below 90 too far, there's not really a whole lot, it seems like, to break the fall. That would be a significant move below what was previously an important high water mark here. So if we were to move upward, though, green line represents some old low points, barring our rather anomalous August 5th low point there. For the most part, price stayed above that line near about 101.50 or so. So that could be a resistance area to consider.
NVIDIA has had a challenging 2025 thus far. The business, which had a huge 2024, is currently facing difficulties that have caused its stock price to fall. Its most recent setback occurred on Tuesday, when it revealed that the Trump administration will essentially prohibit sales to China by requiring the business to get export licenses in order to sell its H20 chips to Chinese consumers. According to the report, NVIDIA would also record a $5.5 billion charge for H20 products and purchase obligations in the first quarter. The statement coincides with President Trump's anticipated imposition of taxes on foreign-sourced microchip imports. Tariffs on gadgets like laptops and desktops will also be part of the measure, which will affect NVIDIA's sales of graphics chips and gaming consoles for consumers and businesses. NVIDIA is undoubtedly facing significant challenges, especially in light of the impending AI diffusion export restrictions that will take effect in May and force specific nations to obtain special licenses in order to obtain access to a restricted quantity of AI chips. Additionally, its stock price reflects this. As of late Thursday, NVIDIA's stock was down more than 6% in the last 5 days alone and 24% for the year. However, there are some positive aspects of the business. Demand for its Blackwell chips will continue to be high as long as tech companies build data centers to support their AI platforms. Nevertheless, that hasn't allayed investors' worries. The Trump administration's restrictions on H20 chip exports to China come after DeepSeek disclosed that it used subpar NVIDIA chips to train its potent AI models. Washington was alarmed by the announcement because it believes China may utilize the technology to improve its military's performance and gain a competitive advantage in the global AI race. The H20s that were originally going to China will now have to be paid for by NVIDIA. This will affect NVIDIA's financial results not just in the first quarter, but also in the next year. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication. So if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
The best part is that you have sort of feelers out everywhere. You have a team that is working hard. You're doing channel checks. You're meeting with folks. What is the vibe on tech? Because people love tech, and it drove the rallies in the years past, and everybody's looking to tech to do it again.
Yeah, I mean, the near-term turbulence is real. I keep using the word whipsaw, Nicole. We get one post from the Trump administration that says, export tariffs are off and everything's good, and then you see tech rallying over the weekend, and you see another one, it's like, nope, kind of just kidding, tariffs are partially on. Tech is strong, Nicole, and tech will be strong again. It's a deflationary force. So I'm talking to a lot of CEOs on the street. I've talked to a number of them from both big cap, mid cap, and they are very uncertain of how to proceed.
Right.
But all of them do understand how deflationary technology is going to be. So they're under a ton of pressure to be able to deliver AI, because AI is going to be what takes the cost out. So if you're a CEO right now of a retailer, a CEO of a bank, you're thinking, am I hiring? Am I freezing costs? What am I doing? In the end, you're going to invest in tech because it's going to allow you to create scale and growth that you cannot do with big OpEx investments in human capital.
So with the NDX down 11% year to date, on the dips, are you buying? Are you, do you recommend buying, whatever, the triple Qs, the NDX, the XLK, or specific names, Mag 7? Do you buy on those dips?
Yeah, you know what I did is I've been doing a bit of a deconstruction of the Mag 7, because in the tariff era, it's no longer one big group. So there's this big disconnect. And part of the Mag 7 really excites me. And if I'm an investor, what I'm thinking a lot about is which companies have high exposure to enterprises, because enterprises are going to be the most likely to continue to invest, especially enterprises that are strong. You and I actually chatted once about the CEO survey that we did. We talked to hundreds of CEOs. They're under major pressure in the next 2 years to implement AI to drive meaningful efficiency growth and also to drive the next wave of productivity. When you're in a moment like this where you have recessionary forces or fears of recession, what happens to these CEOs is they actually are going to look at, where do I continue to invest? Technology. Where do I slow down? People and big capital expenditures, unless you're the Mag 7. The other reason I like a name like Microsoft is because Microsoft has, high enterprise revenue streams, very little consumer exposure, and they're already committing to their long-term CapEx, which basically says we're going to use our long-term operating leverage to put ourselves in a better position coming out of this downforce, because we know this is temporary, Nicole. I don't really care how much people want to debate the exact policy, the exact tariffs. What we do know for sure is that all these cycles come to an end. We're going to find our base, which is going to be certainty in whatever this is going to be.
Right.
And we will accelerate, and tech will be the fastest to come out of that.
So what tech names do you think could work better than others, let's say in the next 6 months?
Yeah,
you mentioned Microsoft.
I mentioned Microsoft. I still feel really positive about NVIDIA. The next couple of years, while there is a lot of catch-up being done, and I'll talk about Broadcom next, NVIDIA has the leadership in this particular space. They have the software, the frameworks, the stack, and you have the CapEx. The $325 billion of CapEx has been committed. We've gotten reaffirmations from Satya Nadella, reaffirmations from Sundar Pichai at Google. They're going down the path they're going to continue to spend. Very little consumer exposure at NVIDIA based on that $100 billion of cash flow they're supposed to create over the next year.
And we see a lot of spending happening here. I mean, the Trump administration has been meeting with tech CEOs.
Yeah.
He's been really sort of saying, we started with that Stargate deal, trying to make sure that these companies are going to build more and more plants here. I mean, do you see more tech happening here? AI, can we be the leader?
It is happening. And look, one of the biggest things that I believe needs to happen out of this tariff war is going to be winning the AI front and winning the IP front. We talk a lot about handbags and stuff. I'm not sure we're going to actually screw the phones in here, and I'm not sure we're going to ever design the handbags and build them here in the United States. Having said that, we do need to control the IP. The TSMC risk, the Taiwan risk is palpable. We need to be able to make more chips here, and TSMC's committed dollars here.
Yeah.
Apple's committed dollars here. Yesterday, NVIDIA committed dollars here, and today we heard from AMD CEO Lisa Su, and she said they are going to build more of their AI here in the US. So it's like, while there's these kind of polar ends of how people politically feel about the situation, I do think this is the outcome the Trump administration wanted, is they wanted to see more AI being built here. And this is for our economic certainty, which is also our national security. So economic security, national security, very closely coupled, and AI is at the forefront of that right now.
So far in 2025, tech stocks have had a difficult time. The larger S&P 500 index saw significant increases due to the Magnificent Seven's outstanding performance during the previous 2 years, but this year has been challenging due to growing concerns that a global downturn may put pressure on corporate budgets. The decline in tech stocks, which account for more than 30% of the index, is the primary reason for the 10% year-to-date decline in the S&P 500 in 2025. Large tech giants like NVIDIA and Meta Platforms have been particularly heavily impacted, falling 24% and 14% respectively. The pain has been felt throughout techland. Global investors, such as Stephen Yu, who oversees the finances of billionaire Peter Hargreaves, the founder of the massive financial services firm Hargreaves Lansdown in the United Kingdom, have taken notice of the sell-off in technology companies. Yu's Blue Whale hedge fund is especially focused on technology, as the industry accounts for around 40% of the company's approximately $1.5 billion in assets. Yu's actions, especially his most recent wagers on the future of NVIDIA and Meta Platform stock, are worth observing due to the hedge fund's size and concentration on tech stocks. Artificial intelligence has seen a surge in investment, which has greatly benefited the technology sector. Following the release of OpenAI's ChatGPT in 2022, which became the fastest app to reach 1 million users, businesses spent enormous amounts of money into creating their own agentic AI programs and huge language model AI chatbots. Enterprise and cloud network data centers have seen a startling transformation as a result of the surge in interest in AI. Hyperscalers such as Google, Microsoft, and Amazon will have invested $192 billion in capital projects by 2024. By itself, Meta Platforms spent $39 billion last year, up from $27 billion in 2023. NVIDIA has benefited greatly from the build-out since its graphics processing units, GPUs, are significantly more capable of managing the enormous amounts of computing power needed for AI program training and operation than the central processing units, CPUs, typically found in network servers. Since 2022, NVIDIA's income has increased due to the high demand for its Blackwell, H100, and H200 processors. It increased by a staggering 114% in 2024 alone to reach $130 billion in fiscal 2025. Cloud clients' increasing investments in AI research and their competence in other business areas have largely funded hyperscalers' purchases of NVIDIA chips. For example, as companies took advantage of robust consumer spending, Meta Platforms' advertising income drove its family of apps, Facebook, Instagram, WhatsApp, and others, to expand 21% year-over-year in the fourth quarter to $47.3 billion. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now, let's dive into today's video.
Yes, there's some good data built up we can rely on if we get positive news, any developments that are positive on the trade front. I think the 90 days was a breath of relief, if anything, sparked a short covering rally yesterday, but it also promises at least 3 more months of headlines that may go one direction or another. Some indecision. The biggest concern is that by drawing out the process, corporations are going to hold at bay any capital expenditure plans that might be on the margin. International producers, shippers may be on pause about making commitments to building capacity in the U.S. 3 months is a necessary step. The market was very oversold, very ready for anything that was a bit of relief, but we're still sort of lost in limbo until we get some better information. Frankly, we thought, and maybe a little too optimistically, we'd have much more clear progress by the end of June, which I think we still will, but has everything been put to bed at that point? Doubtful.
Okay, so I understand why that would mean more volatility in the months ahead, based on the fact that 90 days is just a pause. So I guess in one sense we might be kind of kicking the can down the road. But why haven't we reached the lows? Because I'm looking at an S&P 500 that's still down about 10% year to date. So why does it have to go lower? And what do you need to see to know that maybe a bottom has been reached?
Well, just from historic comparisons, looking at the PE ratio, say earnings on the S&P, for example, are 235 in that range. Not out of the realm of possibility that we see flat or even marginal down moves in 2025's total number. So if you're expecting say 225, let's make it a 5% sell-off or a 5% reduction in earnings, and historically speaking, you put a 17 multiple on that, you're still down around 4,000 on the S&P. Anything greater in terms of earnings downturn and a little bit tighter contraction on the multiple puts us in the mid 3,500 range. That's, I think, a bit extreme. Frankly, we see more value starting in the mid 4,000 range, about 4,600. Would be surprised if the situation really pushes the S&P below 4,000. I think despite the fact that we're playing hardball with these major trading partners, we have to be cognizant of the fact we don't want to do too much damage to the economy. And for better or for worse, and I think the long term it's worse, and it both supports the idea for bringing more productive capacity to the U.S., I think in a selective sense, certain industries that are important, where there's really value add and may have some security. concerns. Some of the more basic productions, we can't give up the idea that international is probably the best price adjusted source for some of that. But going forward, we don't want to damage consumer psyche and the market so much so that we push ourselves into a deeper recession. I say, unfortunately, the top 10% of earners now, 50% of consumer spending. And whereas inflation wasn't really a problem for them in 2022, 23, the stock market takes a hit and money market rates drop, you'll see that segment of the economy will slow down purchases as well.
Okay, so if there's a greater than 50% chance of a recession, as the graphic was just reflecting your viewpoint, does 4,600 or 4,300, somewhere in that range that you were saying, reflect? Does that actually price in the recession that you're talking about?
It's fair. I think it's a fair evaluation. There's still so much up in the air in terms of just exactly what rate will be applied, tariffs to which countries, how the implementation plays out. Is it very industry specific? So many variables I wish I had a realistic handle on, but I think just based on more technical factors and trying to assume what the various thresholds for pain that the consumer and corporate America will be willing to put up with, and but the more importantly, what the government thinks is sort of the outer bounds of short-term pain that they'll willing to inflict. That should be, I think, certainly in the low 4,000s. I think that'll register.
Okay, so you obviously can't time the market, but what do you do between now and then? Are you putting any money to work right now as it relates to stocks, or are you buying bonds? We're seeing a sell-off in bonds once again right now.
Actually, yesterday we've been short stocks about 6% versus your typical 60-40 mix. Thought that we had certainly seen sufficiently oversold readings on the market yesterday. And the fact that it was April 9th and we basically thought something's coming. It'll be an announcement of some progress. Didn't think we're going to have specific deals that were going to be outlined. So at the very least, and also in keeping with previous comments from the president, there's the shock and awe approach that happens to begin with. And then there's the delay, give us time to work on the details. And certainly given the magnitude of the April 2nd proposal and the number of countries involved, there had to be some delay. April 9th wasn't going to be the final, not even, I don't think even any one particular country has ironed out the details to my knowledge.
Yeah, so what'd you buy?
For the most part, we're a little bit in the information technology space. Those names seem to be depressed the most, but the allocation in general was really across the board, just a more top-down view than specific sectors. We continue to be neutral weight in healthcare. That's done well, but the same in utilities. But communication services is one of our favorites at this point in time, and still slightly underweight technology. It's don't think we've seen the bottom there yet. Now, I will say the behavior in technology is beginning a little bit better with the recent lows. We tested below 5,000 on the S&P, rallied a bit, tested it again. Some of the information, the infotech companies we like, are holding up at higher levels, so there seems to be a little sentiment change there. So.
And what's on your list to buy once you see maybe some more of those red arrows that you're talking about?
If we get a complete, let's call it, if a complete washout is in the 4,300 area, below 4,000 or 4,600, I think consumer discretionary names will be quite oversold. I know some of the airline stocks have suffered quite a bit. So those are areas where I think we'll bet on a snapback if we have a relief rally that actually marks the low, and we have some thought that this is now going to continue going forward. There's a better understanding of the tariff implications and possible plans and a runway to assume, or at least to build some estimates on earnings growth going forward, that some of those names most depressed in this sell-off, most of the marginal industries, we're not talking necessities, those will bounce back.
Additionally, generative AI is redefining the metaverse's next phase, from auto-dubbing, editing, and improved visuals to suggesting original content. Large language models like GPT-4 are currently used by streaming platforms to generate material in real time and maintain moderation, enhancing the security and accessibility of digital interactions. The technologies that drive virtual economies, such play-to-earn games, NFT markets, and digital event tickets, already generate revenue for users and creators, even though the larger metaverse is still in its infancy. With an average age of 31, 227 million Americans play video games weekly, according to the Entertainment Software Association. This indicates that immersive material is becoming more widely used across a range of age groups. AI and VR/AR together are enabling platforms to move beyond entertainment and gaming to include commercial and healthcare applications. Metaverse technology is developing on low-latency infrastructures as users desire more individualized, high-resolution experiences. With lightning-fast distribution, platforms such as Hespot Live are revolutionizing streaming for live retail, education, and gaming. Because of its unappealing experience and failure to engage users, the metaverse initially received a lot of negative feedback. The metaverse is still in its infancy, and continuous advancements are driving it forward, even though there was less public interest after 2022. These developments demonstrate how deeply the metaverse is ingrained in digital watching habits, as is the rising demand for video-on-demand services. Due to the rapid adoption of immersive technology, Asia-Pacific is poised for future growth, even if North America now dominates the market with significant competitors and high digital spending. This demonstrates that the metaverse is a fundamental change that is altering how people interact, communicate, and live in digital places rather than only being a fad. The metaverse is turning into a potentially profitable venture as immersive settings upend conventional media. With devices for gaming, data centers, artificial intelligence, and automobiles, NVIDIA is the global leader in accelerated computing and graphics technology. GeForce GPUs, the Omniverse platform, NVIDIA AI Enterprise, and cutting-edge networking technology are all part of its portfolio. NVIDIA has emerged as a leader in digital twins and virtual collaboration thanks to Omniverse and RTX technologies, which are essential elements of the future metaverse. NVIDIA reported record revenue of $39.3 billion for the quarter that ended on January 26, 2025, up 78% year-over-year and 12% from the prior quarter. Due to the need for AI and inference computing, full-year fiscal 2025 revenue increased 114% to $130.5 billion, and data center revenue reached $35.6 billion in Q4, up 93% year-over-year. Due to supply constraints, gaming revenue dropped to $2.5 billion, but automotive revenue more than doubled to $570 million. In the meantime, the corporation returned $8.1 billion to shareholders through buybacks and dividends, and GAAP EPS increased by 82% to $0.89 from the previous year. Furthermore, NVIDIA advanced AI innovation with its Blackwell architecture, which improved performance for reasoning-based AI applications and brought in $11 billion in Q4 sales. The Vera Rubin and Blackwell Ultra architectures, which will shortly be released, demonstrate continuous R&D momentum. Additionally, NVIDIA's reach into edge computing, AI training, and inference was increased through collaborations with cloud providers, automakers, and healthcare institutions. Notably, NVIDIA platforms are now used by 75% of the best supercomputers in the world. NVIDIA projects Q1 fiscal 2026 revenue to be approximately $43 billion. NVIDIA continues to be one of the top metaverse stocks due to the increasing use of RTX and Omniverse applications. NVIDIA's goal to enable intelligent, immersive virtual worlds across industries is demonstrated by the growing deployments of AI supercomputers and simulation platforms like Cosmos and Drive. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.